So look, it was in line with JPMorgan expectations in terms of a 25 basis point rate hike. What we're seeing right now, from my perspective, is a very clear dislocation in rate markets. At the moment, JPMorgan is looking for a 5.25% rate at the end of 2023. Markets are pricing in something closer to 4%, and effectively pricing in 3 rate cuts in the second half. JPMorgan's estimate, second quarter 2024 will be the first rate cut. So there's a very clear dislocation. If I look at elements of volatility in markets right now, rate markets are displaying volatility that we haven't seen since the GFC in 2008. Equity market volatility is basically in line with the normal trends.
Now, why is that, you think?
I think there's significant confusion in terms of the directionality of the Fed. I think what we heard from Chairman Powell overnight was a relatively clear message that, yes, incremental steps that you're seeing in the financial sector, particularly in the United States, will result in credit tightening. That will take the place of some rate hikes. However, he also made it clear that there are different tools for different jobs. And there are rates and the like for inflation and concerns on that side. And there are regulatory steps that can be taken through the FDIC and others to directly address the banking system. And they are separate and distinct. Are they linked? Yes. But there's still 2 different tools for 2 different purposes.
But many have argued that using rates to just control inflation, especially at a time when, there's multiple factors driving inflation in the U.S., and maybe some of those factors are not under the Fed's control. Using it as a blunt tool to fix the inflation problem may not be prudent, and so they need to somewhat balance their own mandates between financial stability versus price stability.
I think that's true, and one of the reasons why we have one more rate hike in May and then a pause for the rest of the year speaks to that, and speaks to the fact that you do have obviously turmoil in the U.S. financial system, particularly in the mid to smaller size banks. But ultimately, for Fed credibility, we don't think we're likely to see the amount of rate hikes that are priced into markets right now.
So there's going to be you're saying the second quarter of next year is when possibly the first rate cut would happen.
Relative to the market expectation of 3 rate hikes in 2023, which we think is extremely aggressive.
Really? Okay.
But in that respect, even if we weren't to see rate cuts coming through, is there still an expectation that we are going to see strong equity performance in the very least for the S&P? Because in so much as we can talk about, the impact that should be present if you're talking about just from a variance in the yields, then that should have accelerated growth in beta. We haven't necessarily seen that. What we've seen more is a rotation into people trying to protect themselves on the balance sheet front. Right. But at the same time, when you look at how the markets are trading, it's almost aberrant, because it appears to be that all of the things that should be taking place aren't, and what you're getting is a lot of short-term activity that's driving all of the action. So are we just being, I suppose, fooled by the market activity, and then the comeuppance is set to come?
So I would agree, particularly with the end of your statement. We're selling rallies, particularly in the United States right now. We do think that we're likely to see significant downside to earnings estimates in the States. That's very different than the outlook for Asia. We have 5% upside to Asia ex-Japan EPS, 11% upside for China, which is one of the reasons why we have an overweight in that market.